Okay, good afternoon, everyone. We're going to get started. Hello to our friends at the Massachusetts Staffing Association. It's good to have an opportunity to present to you again. Very important and practical topic. This isn't a topic that is as maybe theoretical or policy driven as some of the topics we talk about. This is something that's just really a practical, important topic. And the topic is just common mistakes that we see as professionals who really specialize in this industry. Lucky to have three industry veterans alongside of me today. Got BJ Hoffman and Michael Napolitano from Citrin Cooperman. They are two of the practice leaders at Citrin Cooperman, and I know that Citrin Cooperman has a long-standing relationship with MSA, and folks know them, but Citrin Cooperman has one of the strongest accounting and business practices specializing in this industry. They represent, I believe, well over 100 clients across the country, and they're working with folks like you every day, and they were a good source of some of the common mistakes we're going to talk about today. Then I also have my partner, Chris Leddy, with me. Chris is a former in-house counsel at a staffing firm, specializes in staffing industry contracts and employment compliance. And certainly Chris is going to share some of the common mistakes that he sees in his practice. And we put this together, maybe not super scientifically, but we had a conversation and got around the table, and we just started talking about, what mistakes do you see folks making all the time, and what do you think would be a good topic for us to discuss. There's certainly items we'll probably leave out during this discussion. But, I think that we're hitting the things that we see most often in terms of mistakes. So what's the difficulty being in your position? And this is something we were all talking about. And really, it's a difficulty of a change in our political atmosphere over the last 30 years. 30 years ago, we had a really strong federal government, and the federal government took the lead in enacting legislation, and most states were quite content to let the federal government take the lead. Over the last 30 years, the strengths of the federal government has weakened, and states have seen that they want to have more control over the governance and the laws that they enact that govern folks doing business in their states. So over that 20 or 30 years, we've now got a situation in this industry where you're complying with federal, state, and local laws. You're doing it on employment compliance. You're doing it on tax compliance, and it's created obviously a more complicated system, and that's why there's mistakes that we see. But let's kick it off. I think Chris, we'll kick it off with you. Maybe I think the first topic, and something that I know you've been spending a lot of time with, is independent contractors. So why don't you give a brief overview of the typical classification tests that exist in the United States?
Yeah, Marty, like you said, it's really been a hot issue over the past, I would say, couple of years, especially with the passage, everything going on in California. It's kind of put a spotlight on it nationally. Every state has different tests, depending on the type of claim. For instance, if it's a wage claim, unemployment, workers' comp, but each is generally a form of three different tests, right? It's gonna be the IRS test, the economic realities test, and the ABC test. All these tests are very similar in that they're looking for things like control, if the services are being performed by W-2 employees and by ICs, and if there's an opportunity for profit and loss for the IC. The difference between the IRS test and the economic realities test versus the ABC test is that the IRS test and economic realities test are factor-based, right? So they're looking at the situation in totality of the circumstances and looking at each factor individually. Whereas the ABC test presumptively considers all workers to be employees. The ABC test is something Massachusetts is definitely familiar with for many years now. And it permits workers to be classified as independent contractors only if the hiring business demonstrates that the worker is free from control and direction, that the worker performs work that is outside the usual course of the hire entity's business, meaning W-2s aren't performing it, and C, that the worker is customarily engaged in an independently established trade or business. So while on the surface, the ABC test appears to be similar to the other two tests, it is definitely a greater hurdle, especially considering that it puts the burden on the employer to prove the IC status, right? Also, unlike the IRS test and the economic realities test, it's not factor-based. So each of those three prongs, A, B, and C, have to be met. So even if you pass two, you fail one, you automatically fail that test and they're reclassified as an independent contractor. It's, as you're already familiar with it, Massachusetts, it's definitely something that all states are going to want to be familiar with. So if you're engaging people in North Dakota, South Dakota, Missouri, those IC tests may change soon because part of the Biden agenda is the PRO Act, which currently is pending before the Senate, and that would impose California's AB5 ABC test, which is a little bit different than Massachusetts. So it could potentially serve to preempt more lenient local and state laws.
Thanks, Chris. I know, what's interesting is I think many people don't realize what a large sector of the contingent workforce has a tendency to have folks who are independent contractors versus W-2 employees as part of what I would call maybe the custom within that industry. I mean, you have it in IT, you have it in healthcare, but you have it in areas like construction, some super highly skilled areas where, these industries have always had a mix, if not even a predominance of some form of independent contractors versus W-2 employees. And it's kind of funny because I think you and I have seen it, and maybe funny is not the right word, you and I have seen it. We've been telling clients for a number of years that they need to really consider maybe restructuring these relationships. And now they're really thinking about it, and they're thinking about how do I talk to my contingent workforce about this? Because it's really in their benefit too. How do I convince them that this needs to happen? And then how do I determine when it needs to happen, right? Which of these folks really need to be converted? Can you give some high level advice to the folks on this webinar about what they should be considering in determining, whether or not they should be switching the status of any independent contractors they have?
Yep. So I'll go through, a handful of different factors that are looked at by an auditor when they're performing a test, right? Or they're performing the ABC test or any other test that may be applicable there. So you want to look at the types of instruction given, right? If you're telling them when and where to work, direction on what tools you use, who purchases tools, and who's setting the sequence of work, if you're doing all that, that's going to be an employer-employee relationship. Also, if the worker has to perform the work individually, that's also going to suggest an employee-employer relationship as well. That goes hand in hand with the degree of instruction, right? Obviously, the more detailed the instruction, the more likely it's going to be an employee-employer relationship. If you're providing any kind of training to the IC, that's going to be a no-go because typically you're hiring the IT or the IC for their expertise, right? You wouldn't be you're hiring a worker to build them up and grow them. IC should be there for a distinct project to apply their expertise. You also want to look at the investment that the IC is putting into their work, their business. Are they purchasing their own tools and equipment? If they're not, if they're relying on you, again, that would be indicative of an employee-employer relationship. That flows into unreimbursed expenses, right? Typically, you should not be reimbursing ICs for expenses, right? That's not the end-all be-all. I think it's pretty typical that for whatever reason, ICs are reimbursed expenses. However, I do advise clients, or we do advise clients, to get away from that model. And that flows into the next thing, which I think is probably one of the most, if not the most important aspect of it, is the opportunity for profit and loss, right? The IC, to be a true IC, you have to have an opportunity for profit and loss. The way most staffing contracts are written is you're paying them hourly, right? So if they perform the hours, they're being paid. So they don't have the opportunity for loss, right? If they work the hours, they're guaranteed payment. The way to get around that, obviously, is to have a paid when paid clause. So when your client pays you, you'll pay them. That doesn't mean you can't advance them monies as a loan until you get paid. but it really should be a paid when paid clause in there to avoid or to make sure they have that opportunity for loss. Also, you want to make sure their services are available to the market, right? So you can't put any kind of restrictions on them. They have to be able to offer services to other people, other entities, while they're offering services to you. You should also have a written contract. A written contract is required in some states. However, again, it's not the end all be all. It's actually the substance of the relationship that's going to govern. But at least it passes that initial smell test when they're looking at the contract. Last two things, the permanency of the relationship. Typically, at will is for an indefinite period of time, whereas an IC is for a very short period of time for a specific project. Then finally, inclusive of the opportunity for profit and loss, the other most important aspect is, are your W-2s performing the same or similar duties as the IC is, right? You can't say this person is an IC and this person is W-2 and have them doing the same job, because then it's not outside your usual course of business. And that's really where we see a big issue too. So the opportunity for profit and loss and having W-2s perform the same jobs are the two big ones.
And you know, this comes up, Chris, because I do a lot of industry M&A. This comes up on buyer diligence all the time. And you know, as you start to you know, the beauty of our industry is there's such a divergent group of companies out there, right? From very sophisticated to startup to lifestyle companies to publicly traded companies and PE owned companies. As you start to move to these companies that are PE owned and publicly traded, well, they tend to be less entrepreneurial and less risk adverse than, you know, some of the companies in the middle of the spectrum and at the beginning of the spectrum. And so when they go through diligence, they're constantly asking, well, Marty, how is this person a W-2 and this person at the same client with the same role is an independent contractor, right? This is a question I get all the time, and I have to, you know, try and explain it, and we have to worry about how we're going to structure risk in these contracts. So I know you mentioned that Massachusetts uses the ABC test. I forget, Chris, Massachusetts, does it have some exemptions from the ABC test that folks should know about?
Not really. Everything is going to be really fact specific. It's going to be a case by case basis. The statute even goes so far as to state that securing workers' comp, which is usually indicative of a true independent relationship, is not even considered in making the determination of whether somebody is an IC or not. So Massachusetts law is very strict. The exemptions are going to be found in case law, and it's actually it's not funny, but funny is a bad word. But when I talk to most clients throughout the country, they know to stay away from Massachusetts and California when engaging independent contractors, right? They know they're off limits, don't do it. It's a rabbit hole they don't want to go down. So yeah, no set exemptions, so to say.
Got it. I know that this has occurred in a couple areas across the country. You have the advantage of all these compliance charts that you keep around the office, and you don't share them with me as often as I would like you to. But I forget whether, Matt, I know some states are requiring companies to withhold taxes even for independent contractors. I forgot, is Massachusetts one of those states? Massachusetts
is not. There's only a few out there. California, obviously, if you're doing business, I think everybody does. If you're a national firm, everybody does business in California. California does require the 7% withholding unless you meet one of their exemptions. So really, you got to look when you're going into each state or you're hiring an IC from a state, you have to make sure you're complying with that applicable law in order to avoid really not collecting trust funds on behalf of the state.
Thanks, Chris. So, you know, let's talk about solutions. We've identified the problem. Let's try and identify some solutions. Obviously, one solution is not to have independent contractors, right? But that's not always practical because there are still large populations within contingent workforces that demand being independent contractors. So you've got that tug of war. So let's talk about solutions if you are going to continue to have independent contractors in your contingent workforce. You know, give a few solutions that can mitigate risk. Obviously there's no magic pill that can eliminate risk here, but gives some solutions that can mitigate risk.
Yeah, so you want to make sure that they're a business entity, right? They're in good standing. They have a certificate of formation. Get those from that IC, right? You also want to have proof of their W-2 employees, right? You want to know how many they have. You want to make sure they have multiple clients, multiple employees. Get a redacted copy of their 941, right? You also want to, I think the biggest thing too is the smell test, which would be Google, right? Google this person. Or entity. Do they have a website? Do they have a company phone line, address, email address, physical business location? That's the first thing an auditor is going to do. And if they can't find it, you can't find it, it's going to set off red flags right from the beginning. Make sure you add a paid when paid clause into your contracts, right? As we discussed, they have to have that opportunity for loss. You don't want to have a right of termination at will, because again, at will should be reserved for employees. You want to make sure they have insurance. You want to get a copy of their certificate of insurance. You want to be named as additional insured, with their insurance being primary, yours being non-contributory. You want to get indemnifications from them, right? If they are reclassified, or any of their personnel are reclassified as being your employees or joint employment, you want them to indemnify you for that. And lastly, again, you just really want to look at, are your W-2s performing the same functions? If they are, it really should be a no-go. And just one more thing, Marty, I think as a practice point, consider class action waivers and arbitration agreements, so you avoid any kind of big hit that could come from a potential wage and hour issue, misclassification issue. So everybody has to do it individually. Plaintiff's attorney may not be so inclined to take that case.
Thanks, Chris. Chris, I don't know if you can look in the chat. There's a question that just came in, and I think the first couple elements of that pertain to what we're talking to right now. Maybe you can take a look at that and answer that question. And then I'm dying to bring BJ and Michael in on an issue that I also see all the time in M&A transactions.
Yeah, so I think the first question is, a single corp, that won't do it, right? That's going to be, it's a pass-through entity. The auditors, Department of Labor, whoever is auditing you is going to look right through that and say, no, it was set up to avoid paying payroll taxes. Do we need to register as a foreign business in states where we hire remote internal staff? I think that's a tax question BJ could probably answer. I think the answer is yes. Do clients typically ask for the workers' comp codes for each requirement? It really varies by client. Some people put in their MSA, some do not. And I think it really varies by industry. So yes and no. I think who is responsible for determining the right workers' comp code? And that'll be contractually, that should be in your contract, who is responsible for it. So you definitely want to delineate that responsibility and that representation and warranty in that contract. And I would push it onto the client.
Thanks, Chris. And that one question, BJ, I think that's actually an issue we identified, so we'll probably answer that when we go through that question.
Yeah.
But thanks, Chris. I want to talk to Michael and BJ a little bit now. Another issue that over the last 10 years I've seen tremendous focus on in M&A deals. There's somebody, I think, with some background noise. I don't know if they can get muted, Mike, or if you're on and you've got background noise, if you can mute. Thanks. So BJ, I see all the time a great deal of concern by buyers about state and local tax compliance. And it was complicated and a minefield for staffing firms before COVID, and now I know it's only gotten more complicated. So maybe we can talk about what the state of the land was before COVID first, and then move on to post-COVID.
Yeah, thanks, and great conversation. In fact, I almost wanted just you guys to keep going. Fascinating stuff on the independent contractor side. But yes, we as accountants in the staffing industry, even as far way before COVID, we're navigating the intricacies of the state and local tax compliance issues. State and local tax, we accountants call that SALT, state and local tax. As you know, as staffing firms know, you've got contract workers, W-2 employees, all over the place, littering the geographies, very often crossing boundaries with other states, cities even. And you also often have recruiting centers, bricks and mortar at times in other jurisdictions. And before COVID was here, those would serve as certain tripwires, driving you to comply, to register, to file taxes in all these other states. COVID comes along, and then everybody generally figures out that, well, we can work from anywhere with regard to your internal workforce. So whereas before maybe you had headquarters in Boston and 20 internal employees on the sales and recruiting side, now everybody scatters. They go to their home in Maine, their vacation residence in Florida. Everybody is everywhere. And with that comes all these a litany of new questions. Again, physically having an employee in another state generally creates that tax nexus, compelling you to file payroll taxes and compelling you to file income taxes and registering as a foreign corporation, so on and so forth. It's a compliance nightmare. And, certain states offered temporary respites during COVID to sort of exclude remote workers from tripping that nexus. But a lot of those temporary regulations have lapsed now, and people continue to work everywhere. And that opens the door to this whole notion of do you comply or do you not comply, and what does it mean? So Marty, yeah, I mean, we as accountants, we're dealing with this all the time with our staffing clients, pre-COVID and only more so now.
Mike, can you talk a little bit about post-COVID remote work environment and areas where staffing firms might find themselves getting into trouble with respect to SALT issues?
Yeah, thanks, Marty. So we've onboarded probably a dozen new staffing firms. And what's interesting is more than half the business owners felt that they had some deficiencies in their state reporting. They just had a sense that they should be filing in other states. So the reality is there's 3 touch points when it comes to your obligation to file in a state. And that's going to be where you're located, which is obvious, where your customer is located, and where the employee is performing the work. So those are the 3 bits of information that your professionals will need to know to make a determination. Hey, do we need to file in these states? And the other point, Marty, you touched on, especially in the M&A world, is compliance. We've just gone through 3 PE deals with staffing firms. And on the compliance side, the 2 main areas of focus were proper registration in the states you're operating in and proper reporting of taxes in those states that you're responsible for. And I think everyone needs to be aware, what does that mean if you're not in compliance? Well, the purchaser is going to put money aside in escrow for any potential taxes they feel that were not paid. And another area we're seeing on the M&A side, just a little outside what we're talking about, is we had a client who was not correctly reimbursing I should say they were reimbursing their employees for expenses, but did not have the proper system in place for accounting for it. So on the M&A side, the acquirers are very savvy, and they will look at all of your compliance. And if you're not in compliance, monies will be put in escrow. So it's important for everyone to know if you are looking at selling. Just to give you an idea of how big state and local tax is, we now have 9 people dedicated just to state and local tax, because it's not only the states that you have to be in compliance with. I always use Ohio as an example. There's a lot of localities within Ohio that also require separate filing. So it's important that your professionals understand where you're filing. And just one more quick example. A California-based client had an internal employee in Texas, and in their mind, it's an internal employee. We have no filing responsibility because we have no sales. Understand a lot of the states are now talking to each other internally. So their payroll reporting division is now talking to their business tax reporting. And if you have payroll returns being filed and there's no business tax returns, that will generate notices in a lot of states. And what you have to deal with, it's more of a nuisance, Marty. you're getting these assessments. And if you don't respond, the states are just going to assess. And this one client had a 4-year non-filing and were assessed $100,000 in estimated taxes. Clearly not the case, but now you're engaging us to go back and rectify it. So it's important to really take stock where you're operating, where your customers are, and where your employees are performing the work.
Those are great points, Mike. And on the M&A point, not only might you have an escrow, but they're going to make you make representations about your compliance. And the first representation I always see is that you've authorized to do business in all of the states that you're required to be authorized to do business. And with that, BJ, I'll turn it over to you, because my clients say, well, I only do a little bit of business here, so I don't need to register. What's your answer to that, BJ?
You've heard those questions too?
I've heard that. I've heard that.
Yeah, very, very common among our clients in the staffing space. You hear like, BJ, I've got one contractor, he's set up to work in Tennessee for 1 month. That's it. It's an accommodation for a client of ours. I don't want to register there. Do I have to register there? What's it mean? I'm not paying taxes there. And look, I get it. I really do. There's got to be an evaluation in your mind, the client's mind, that there's a cost benefit to registering in these places. We as accountants, we have to advise you of the right thing. You have one contractor working in Tennessee for 1 month. I'm going to tell you, yeah, technically you need to file, you need to register with the Secretary of State there. You have to get them up and running on payroll. You got to file annual income taxes in Tennessee, all for a month. And I get it. It's, there's a cost there. And my job is to make you aware, you, the client, aware that give you the information with which to make an informed decision. And what are the risks and what's it going to cost if you get caught? And, I understand why a business owner may just say, bag it, I'm not going to worry about it. But along the points, Mike, Chris, and Marty, it's a supercharged M&A environment right now. And if this is going to come up in due diligence, and if you are a habitual non-complier in a litany of states, it is, in my mind, it's going to drive down the value of your company, because there's risks there to the buyer. Yeah, we can talk about escrow, but it's an indication of you not having your act together too. And that can impact value. So yeah, it's a big deal, big deal.
And I think you raise a good point. Escrow is tricky with respect to taxes, right? So there's always, not always, there's often an indemnity escrow. And that's to guard the buyer against areas where there might have been unintentional or even intentional misrepresentations as to the reps and warranties that you give. The problem with taxes is because those escrows are usually short term. They're usually 12 months, 18 months. But as you know, tax liability and the statute of limitations on that is much longer. So while a buyer may say, well, I have an escrow, those escrows usually don't last beyond 18 months. So then what do? If there's a lot of tax issues, they have almost no choice than to also have it impact you in price, because they can't hold an escrow for 6 years. It just doesn't work that way. So yes, you got an escrow to deal with, but then if it gets to a certain level, escrows don't always help, and that's where you have price impact. Mike, back to you, because we've talked about obviously income tax, but this surprised me when I got into staffing 10, 15 years ago. You have to worry about sales tax in some areas as well. Can you talk to folks about these other taxes that sometimes are tripwires that folks are tripping over?
Yeah, the beauty of the states is there's no uniformity. So every state has different rules, and there are only a small number of states that will assess a sales tax on permanent. And Connecticut is one of those states you have to be careful in. If you're operating in Connecticut, there could be some attachment to sales and use tax. So the key I want to drive home is the relationship we have with our staffing clients is we ask them to let us know, Marty, in advance of going into a state. We joke internally, if we have a client that's looking to do business in California, we tell them run to the hills unless it's a big contract. Stay out of California as much as you can. But it's important for us to know, or your professionals to know in advance, because you don't want to run into a situation where you should have been charging sales tax. Because if you're caught several years later, good luck going back to that customer saying, hey, we were just audited, we should have charged you sales tax, and would you please pay it. It's not going to happen, and you will be responsible. So if you have professionals that understand the state reporting, work with them so they know in advance where you're thinking of doing business. Is there a sales tax reporting requirement? And I'll give you one quick example of a funky case. We have a client that works with Con Ed, and they were adamant that the services they were provided were subject to sales tax, and we disagreed with them, but they insisted that we charge them sales tax, Marty. So we went ahead and charged them sales tax, and we're remitting it. But you will have these funky cases. It is limited on the states that are charging sales and use tax, but you don't want to be conducting business in that state and not know you're subject to sales and use tax. So make sure your accounting professionals understand where you're doing business.
Pennsylvania, I'll just add, is one of those few states where you got to really be mindful of sales tax issues and staffing. So
we got a great question that just came in. We'll start on the tax compliance side. Other difficult states besides, Massachusetts and California that people want to be really careful of on a SALT basis?
I don't know. What are your thoughts on New York? New York is friendly towards employees, typically, is my observation.
I think the answer is when you go from a compliance, and I'll refer, Ohio is a little bit difficult because of the localities. There's a lot of local reporting. I think most states, it's not the difficulty, it's operating and not having the knowledge of what you should be doing is where the problem occurs. I think it's understanding what your reporting requirement is in each state, and it's not necessarily the difficulty of being compliant. It's not knowing you should have been compliant is always the problem.
Right. Chris,
sometimes I think that the more sophisticated this is in terms of big dollars, California, you say what you will, it's a sophisticated state with a lot of money flying around. I think New York State's similar, and I think that draws a certain element of sophistication to the taxing authorities there, and can make it more difficult or more sticky as an employer at times. Just a broad brush.
That's an interesting observation. Chris, let's go on to answer that question from an employment compliance basis. I'm going to throw Illinois out there. Illinois seems to be trying to match California these days in what it would consider progressive employee protection. What other states do you think are moving in that direction or have moved in that direction?
So you have Illinois in the Midwest, and slightly Michigan. Then basically how you want to look at it is blue states, employee friendly, red states, employer friendly. So collectively, the Northeast, employee friendly, right? So anywhere, New Jersey, Pennsylvania, New York, Massachusetts, Connecticut, especially, Vermont, they're all going to be employee friendly. California, Washington, even Nevada has become more and more employee friendly. So look at the coast, look at the West Coast, look at the Northeast. Those are going to be your employee friendly states. As you get more and more south, they're less employee friendly and more employer friendly. Illinois is kind of the outlier. Again, like Marty said, trying to match California, whatever they can do, we can do worse for employers. Connecticut's the same way. Massachusetts has been that way as well. I think really all the Northeast has tried to match California first step.
Thanks, Chris. Chris, let's talk about like COVID and testing. I think it's a very hot topic, and it's an area I know that a lot of our clients have been talking to you about. So let's spend a few seconds in there, because I think there's some landmines within that. So obviously testing's on a lot of people's minds. There's a lot of mandatory vaccination requirements coming out. But I think a lot of folks fail to realize that there are some wage and hour issues and wrinkles that come into mandatory testing and these vaccination issues. Can you highlight those for us?
Yep, for sure. So federal regulations state that time spent by employees waiting for and or receiving medical attention on the premises or at the direction of the employer during their normal working hours constitutes hours worked, which they have to be paid for, right? Courts have also interpreted this rule to include compensation for mandatory testing, even if the employer requires that it occur outside their normal working hours. Likewise, the Department of Labor has stated that undergoing COVID-19 testing outside of working hours may be compensable where it is necessary for the employees to perform their job safely and effectively during the pandemic. So because the transmission rate is so high right now, presumably almost everywhere that would meet that requirement. So essentially, it's likely to be found that employees must be paid for the time for testing if it's done as a requirement of the employer. This is also consistent with many states out there who require employers to pay for all employee time spent while under their control or direction.
So let me make sure I understand this, because this always confuses me. I impose a requirement that somebody has to be tested. They have to show me the test. They go on Saturday to the physician clinic, CVS, wherever they go. That's compensable time on Saturday?
Likely, if it's a requirement for them to perform their job safely and effectively, right? So if you're in a high transmission area, then yes, 100% that is going to be compensable. I mean, alternatively, you could have them go while it's during working hours. Not the best solution because obviously it's taken away from working hours. But yes, it is going to be compensable.
I think many folks are kind of missing that potential wrinkle, and we know it's fact sensitive and state sensitive, but there's certainly, as you said, case law and precedent out there for somebody to say that that's compensable time. And then I guess this is the follow-up question. What about the expense of the test? It's mandatory that I have to go out and be tested. Are we reimbursing these employees for the expense of these tests?
Yeah, maybe. The cost of the testing, if it impacts an employer's FLSA obligations, then yes. So if employers do not reimburse employees, and it could constitute an impermissible wage deduction if it reduces an employee's protected wages, which is below minimum wage, as it will likely be seen as primarily benefiting the employer to minimize workforce disruptions and comply with workplace safety requirements such as OSHA, right? The EEOC has also provided guidance under the ADA for medical examinations, specifically in the COVID-19 context. According to the EEOC, when an employer requires an employee to go to a health professional of the employer's choice, the employer has to pay all the costs associated with that, right? This typically occurs where the employer requires a testing at a designated site or provides on-site testing. Also, you have to look at several states too. Again, California being one of them, specifically require reimbursement for business expenses that the employee incurs. So you have to check the applicable state laws for each state that your employees are in that you're requiring this, right? So it's not a federal, that's not a federal issue. There's no federal requirement that you reimburse expenses unless it brings them below minimum wage. That's on the state side.
Thanks, Chris. We just got a question. I'm not sure I understand it, so maybe we'll circle back to that at the end. Let's switch back to Michael and BJ. This is a question I think I've always wanted to ask you guys, and now I get the chance. You literally see hundreds of tax returns for staffing firms every year. You know, check off the big mistakes you see when you're looking at these tax returns.
Yeah, well, I mean, we do get to see a bunch of staffing firm returns, and I'll say that when you talk about the basics and maybe missing the basics, right on the face, page 1 of your return, if you're filing a partnership return, page 2 if you're filing an 1120S, is a little box that says how you are filing, under what methodology. And it can either be cash, the cash basis of accounting for income taxes, or accrual. And without getting into the details and the nuance of into the weeds of accounting rules, suffice it to say that accrual basis taxpayers essentially pay taxes on the revenues when they bill their clients and customers. And cash basis taxpayers only pay taxes when you actually receive payment from your customers. And it works similarly on the expense side. You get a deduction when you receive an invoice, if you from a vendor, when you're on the accrual basis, or if you're on the cash basis, you get a deduction when you actually write that check. So as you know, most staffing firms tend to run with their, at any moment in time, with their accounts receivable outpacing their accounts payable. So we see a lot of, for some reason, we see a lot of staffing firms electing to pay their taxes under the accrual basis method, which doesn't make much sense to me because it essentially accelerates the tax burden when it's not necessary to do so. You accelerate and are paying taxes when you've yet to collect the money from your customers. Not sure why you would do that. I mean, certain businesses are required to go the accrual method, but generally, unless you're a C corporation, staffing companies are going to have the option to choose between accrual and cash basis. There's an easy fix, and this is actually really important. You can make a change. You can switch from accrual if you happen to be filing under accrual. You can make a switch to cash. And the great news here is that when you make that change, in the year in which that change happens, you typically get a really, really big catch-up tax deduction that can, at times, eliminate the need to pay income taxes for a year. So we've done that any number of times recently. That's a biggie and a really basic one that is often missed, I'm finding, with staffing firms when I look at a tax return. So that's a key. Mike Napolitano, I mean, you want to talk maybe about officers' compensation when we pick up a tax return, you know, a common issue?
Yeah, there's just small things, but it could really impact your taxes. So several years ago, under the Trump administration, there's qualified business income. So without getting into the details, it's a 20% reduction of your taxable income. So just for argument's sake, you have $1 million of taxable income, you get an automatic 20% reduction, $200,000. If you're in the 30% tax bracket, that just saved you $60,000 in taxes. So in planning for year end, the mistake we see with staffing owners is they're taking excessive salaries. So they're taking $500,000-600,000 in W-2 compensation. So in my example, if you have $1 million of income and you take a $500,000 W-2, now you only have $500,000 of taxable income, 20% reduction, that's $100,000 deduction. What you have to remember is your W-2 wages do not qualify for QBI income. So essentially what you're doing is you're converting business income into W-2 income, and you're missing out on that 20% QBI deduction. So what we like to do is we always ask for prior year tax returns because we're looking for these common mistakes. And what's interesting for BJ and I, it's just common knowledge you want to be cash basis. And how many new clients we've brought on over the last 2 years that are still accrual basis. And over the past 2 years, some of our clients that are taking 90+ days to receive payment, if you think about it, you do your December billing, and if let's just say you're billing $1 million in December, and you're not collecting it for 90 days, you're paying taxes on that income in the month of December. So we spend a lot of our time doing year-end tax planning on the cash basis and trying to help our clients manage their cash flow. So those are two big areas that are very easy to address.
Yeah, the owner's compensation is a real big one. You need to manage that process in order to maximize that, what we call the pass-through 199A tax deduction. But also we see I'll see a lot of S corporations where there's no officer W-2 compensation at all on the return. And that's an audit red flag. That's an easy one for the IRS to pick up on, because you, as an officer of an S corporation, are required to take a reasonable amount of W-2 payroll. No one's ever really defined reasonable, but if you take nothing, that's not reasonable, and that'll get Uncle Sam onto you very quickly. And if you take too much, you're shortchanging yourself on these 199A deductions. So we really like to dig in there on the tax returns and see, what's the right level of compensation, what makes sense. Those are some biggies, Marty.
Yeah, those are great, very practical and in some ways simple, right? I mean, I expected you guys to get into some pretty arcane issues, but these are two issues that can just jump right out at you. So those are the great advice, great advice. We do have some great questions, and we are going to get to them. I just want to proceed with a couple more topics, and then we'll get to those questions at the end. Obviously, PPP is really wound down. We don't have to talk about that every day like we used to as professionals in the industry. But there's still the RTC credit, right? So we still have that credit out there. BJ, maybe you can share, what you're seeing in terms of the ERTC credit, what types of issues, what type of advice you're giving to staffing firms with respect to that credit.
Yeah, some of this stuff has been beaten to death, certainly with PPP, as you said. The employee retention credit, I'll refer to it as the ERC, is a credit that can be very, very lucrative for staffing firms. And our advice, to make a long story short, is you owe it to yourself to get informed about this. There's a lot of gray areas associated with the employee retention credit, but you need to learn about it, and it can be a really meaningful dollar item out there. To sort of cover the really high level points on the ERC, the employee retention credit, to be eligible for the program, whether it's in 2020 or 2021, you need to meet one of two-pronged eligibility tests. One is a revenue decline, post-pandemic versus pre-pandemic. And whether it's a 50% revenue decline in 2020 or a 20% revenue decline in 2021, you got to tick that box. And if you have a revenue decline compared to your pre-pandemic era, you're eligible. You need to explore this program because it can mean a lot of money. The other one that's less known and that I want people to think about, although this is not necessarily an endorsement of the second test for eligibility, is what's called the governmental orders test. And essentially that test says that even though you may not have had a revenue decline or one that is sufficient enough to shoehorn your way into the first prong of eligibility, if you suffered a full, and I'm reading here, a full or partial being a key word, partial suspension in operations due to governmental orders limiting commerce due to COVID, you may be eligible for the ERC as well. So this is an untested, really gray area. But if there are arguments that can be made that might allow you to get comfortable with proceeding with the ERC, it can be big dollars. It can be $5,000 per employee in 2020. More importantly, it can be up to $28,000 per employee in 2021. So the dollars can really add up. We could do a whole session and have done whole sessions on the employee retention credit. But I think you just need to know that you need to have these conversations, and you can go back and amend payroll tax returns in 2020 and 2021. There's no immediate rush on that. So unlike PPP, there's no funds that are expiring, but an area for exploration for sure. And I know, Marty, you've got some thoughts on the ERC that lend themselves to some caution as well. So.
Yeah, I'm gonna give my thought, but I want to revert back on that when you account for the credit in your tax returns, because I've had that question come up in a couple of deals I've been working on. So I want to revert back to that as to what the best practice is there. Look, I agree with you 100%. People should be exploring this. It is a potential opportunity and a great program. My experience is that I believe some folks are getting overly aggressive with respect to that second criteria and what counts as a as a partial closing. You know, that concerns me. That concerns me. We've had a number of clients come and ask, you know, and trying to find a way to qualify because it's obviously big dollars. So I agree with you. People should be exploring it, but I would be careful about how aggressive you're being to say you qualify under a partial closing. There's no real guidance out there.
Yeah,
unfortunately, it's not like the PPP program where they came out, maybe albeit slower than we hoped, but they came out eventually with guidance that would help you on these things. There's no real guidance out there, but I've certainly had clients come to me and say, yeah, this is a partial closing, and I've said, I'm not comfortable giving you that advice.
Right. Yeah, it is totally vague, untested. But you know, we've had clients that have knocked the cover off the ball during COVID and have still gone for this. Not saying they're wrong or right, but there's some risk there. There's certainly some risk there of a governmental oversight, some audit coming back and saying this wasn't meant for you. You thrived during the pandemic. Now you're becoming piggish. That risk exists, but there's you know, there's not a hard and fast rule. You know, there are a lot of arguments to be made for moving ahead and pushing ahead with it. So, you know, you need to get informed on that. With regard to your tax question, another area of a vague aspect of the ERC is if you are getting these credits, as it stands right now, to the extent that you are amending 2020 payroll tax returns and still waiting for those dollars, those refund dollars from this credit, the technical guidance right now is that you need to amend your 2020 corporate tax returns and pick that up as income, regardless of the basis of income, cash or accrual that you're filing under, which is sort of counterintuitive. There's been talk of updating that guidance, and it's sort of another area of unknown. Like as it stands right now, if you got a 2020 credit and are still waiting for that money, you're supposed to go back and amend your 2020 tax returns for that. Whether people will or not is another story, because it doesn't seem to make conceptual sense, but in any event.
Interesting. Mike, real quick, we're running out of time, so like we're gonna have a lightning round with you. We talk about tax returns, right, and some of the common mistakes. Can you lightning round some common mistakes you see on financial statements?
Yeah, we're going to make this quick. So on the financial statement side is proper cutoff. So on new clients at year end, December 31st, we're not seeing the proper accruals for those last couple of days of billings that occurred in January and the corresponding payroll. It's also proper revenue recognition, making sure you're breaking out if you're doing perm versus temp, is that you're separating it on the financial statements. Proper accruals for your insurances, workers' comp is a big one. So we'll see, you know, a company have a banner year, 1 year, they're dropping the next year, they get their worker comp assessments and you're not properly matching the expenses with the revenues. That's a big one. And one big change that's happening for everyone to be prepared for this year when you're doing financials is they're changing the accounting for leases. So if you have multiple offices where you're paying rent, your accountants are going to start asking you some different questions, because those will now start appearing on your balance sheet as an asset and liability. So you need to be aware, does that affect any of your covenants when that occurs? So it seems like, Marty, every year there's some revenue recognition rules that change. Now you have capitalization rules that are changing. So any of you that are having reviewed financials or audits, you're going to see some additional changes occurring this year.
Chris, I'm going to force you to be even faster because I want to get to these questions. So I'm going to put the pressure on you. A lot of oversights that you see. I mean, they see hundreds of tax returns. I know you work with dozens of MSAs each year. I'm going to challenge you. Top 2 mistakes that staffing industry clients make in their MSAs.
Yeah, I think the the biggest one is not pushing hard enough on the indemnity provisions, right? I think most of the times you're able to get a mutual indemnity provision, unless it's a big client, right? It's one of those Fortune 500 companies where you're just trying to land that big fish. You don't care what the indemnity says. And I think that's the mistake where it's made, right? I've had clients where there's been sexual harassment to their employees by the client's employees. Well, instead of losing that client and possibly triggering the indemnification provision against the staffing firm, they just ended up paying $50,000, $60,000 to make the claim go away. So there should definitely be indemnifications for their acts, for the client's acts or omissions, things like discrimination, any kind of breaches of contracts, at least be a mutual, right? And I think now with COVID is a compliance with laws provision. It should say that the client is going to comply with all laws with regard to your employees, right? So you're putting them there. They should be complying with OSHA compliance. They should complying with anti-discrimination. So when you're having that compliance with laws provision combined with your indemnity provision saying that there's a breach of contract, they're indemnifying you for that. Now you've just caught any violations of law on the client's end. So those are the two real big ones that I see recently.
That's great. You know, same type of story that I've had with a client. Literally, the client has a worker who the client asked to do something completely outside the scope of what they would do, which was operate a special machinery. They're in the process of operating this special machinery on a loading dock and get sandwiched between two incredibly heavy objects that close on them because they don't know what they're doing in operating this machinery. You know, our client didn't have any indemnification rights for this huge loss that occurred because of this. So it also goes to the scope, right? Like also next to the indemnification, for me, it's like, whose responsibility is this to begin with? You know, and I think you're talking about that a little bit. And one last thing I'll ask you, you know, clients are so fearful of trying to negotiate these contracts, but have you ever seen a client lose a contract because they asked for changes in it? Have you ever seen that in your experience?
I've never seen it.
Right.
Never seen it. They can ask and they'll tell you no, right? Or they say it's non-negotiable, but it's always worth the ask.
Right. Right. And so I don't understand why there's not more asks by our staffing industry clients. All right. There's a couple questions, Chris, and I think these are both really for you. First one is going back to the COVID testing. And the question is, will the testing done because of the federal mandate be compensable if done outside of work hours?
That's a good question. I don't know. I think everybody's waiting here how the COVID expenses, how the wages are going to be allocated when the rules come out. The rules have not come out yet. They're still waiting to be approved. So hopefully within the next, few weeks, we'll know. And again, that's still pending any injunction filings that where the states or private businesses may file as well. So it's not clear yet.
Right. So the federal's a little bit different than the state law because we anticipate that the federal government is going to give actual guidance on compensability, whereas at the state and local level, that's where that case law you were talking about kicks in, and you have to kind of make your own determination. Is that fair to say?
Yes. And listen, I think part of the problem, the reason it's been so delayed is because, I'm hoping it's because they're considering all the expenses that they're going to be pushing onto the employer by mandating this, right? They're obviously going to pay more hours. They're going to pay for COVID testing. It's not cheap. You're going to probably want to talk to your insurance company, see if your insurance company covers the COVID testing, the cost of it. It's multi-factored when they're considering this rule.
And then Chris, the last question that's up there, maybe you could just read that because it's got several components to it and give an answer to that.
Yeah, so basically the question is, how do you pass on the costs of state mandated programs such as paid family leave and the retroactive COVID-19 assessment? You have to do it through, first of all, you should have a provision saying there's any increase in statutory benefits that your gross margin should never be below X percentage, right? And that's a clause we like to see in there. We try to push for. Don't always get, but that is a clause that you can have in there. Second of all, the other way to do it is you got to look at your load factor, right? You got to look at how you back into your gross margin. So you have to account for those costs at the outset, right? So your bill rate versus your pay rate, you need to figure that out and build that in. Those are the two ways to do it. And we can talk more offline about that provision in a contract, making sure that your gross margin stays at least X percentage if in the event of any change of law.
Thanks, Chris. Well, BJ and Mike and Chris, it's always a pleasure to have an opportunity to speak with you guys on these issues. It's without fail that I certainly gained some insight. Hopefully the folks at MSA have gained some insight as well. And I wish everybody a good day, and we look forward to seeing you and having an opportunity to speak in front of you again.
Thanks.
Thank you, everyone.
Thank you, everyone.